Hello, traders. This is General Romulus coming to you live from the Forum in ancient Rome. And wow, am I glad to be with you today. There was a lot of interesting trading going on last week. And if possible, that interesting trading activity was eclipsed in about 1 nanosecond this morning with a tweet or a post or some kind of an update from President Trump himself. And without too much more preamble from your old buddy General Romulus, let's get to it, shall we? Okay, well, always remember, I am not a stockbroker or financial advisor or your personal money maven. I'm simply here for educational and informational purposes, but glad to be able to help you if possible. Okay, like we mentioned, some interesting trading going on last week. A couple of trading days ago, early in the week, the S&P 500, the mightiest, well, with the exception of a legion of General Romulus from the ancient Roman Republic, the trading activity was nearing the 200-day moving average, something that we highlighted and mentioned, well, several times. What did we keep saying the last several weeks? That price and the 200-day were going to meet. And first they did in the futures market, which we highlighted, and then they did in the cash market here a couple of days ago. But first kind of visit there was Friday the 13th, auspicious kind of day if you are superstitious that way. Going back in time, not all the way to my time in the ancient lands, but going back in time to a little less than a year ago, that was the last time that price action had been really anywhere near the 200-day moving average. See, this is the tariff tantrum situation right over here. It breaks above it in early May, retest, and then bye-bye Charlie, never looks back at it. Critically important for what is going on in the intermediate, longer-term trading picture. Finally visiting it here almost. Again, Friday the 13th, a little bit of a rally, and then breaking down below it. That is an important part. We had this lower yellow line drawn in for some time. Well, you guys have seen the videos for months. We had this lower yellow line. You want to know how we do that? I'm sure you do. Get a hold of me directly, RomulusTeaches@yahoo.com. Again, RomulusTeaches@yahoo.com. Anyone who's been watching these videos for more than a couple of weeks, you've got to be thinking, why is Romulus the only one in the entire world who seems to be able to get this stuff right consistently? Because that's what we do around here. It is consistent returns regardless of market direction. I'm so glad you brought that up. That's my favorite thing to try to do in life, other than escaping a lion when I'm fighting in the arena. Okay, and yes, even old General Romulus gets in the arena. Keep the skills sharp. So broke down this huge volume spike, by the way, on Friday when it fell below our lower yellow line. That was caused by something called triple witching, not a part of our running superstitious conversation from a minute ago. But when there's options and futures and other derivative type products that are coming to an expiration, they come due every 3 months. So if you go back 3 months ago, you'll see the volume spike. Another one here. That is not some type of reaction to war or otherwise. It is a mechanical situation due to options and futures expiration dates that come once every 3 months, causing a very large volume spike toward the end of the day. So ignore the huge volume spike. However, we do see because it was trading high anyway prior to 3 p.m., volume was high, market was down. That makes 3 days in a row of distribution, and dating back, we've been talking about this, all the way back here to January 13th. That's now 2.5 months of trading behavior where we see way more distribution days than we see accumulation days. As a matter of fact, I think since January 13th, we've only seen 2. That's right, 2 accumulation days in that entire run, and that's probably 50 trading days going. So the institutions, the big money, the portfolio managers, the banks, the brokers, all those people that you wonder what they do and where they do it, New York, London, some parts of Germany, Chicago for sure, Singapore, Tokyo, big money. They're not interested and haven't been for some time in chasing this market higher when it has put on a couple of rally days. This is very important to keep in mind. And when there are some selling days, they do seem interested in selling more aggressively. So they're following prices down. They're not following prices higher. And yes, today's a big up day. I mean, anytime you see the S&P 500 go up 2% or more, Dow Jones Industrial Average up almost 2.5%. NASDAQ over 2%. Russell 2000 small caps up almost 4%. Anytime you see that type of trading behavior, that's not that common. I mean, 2% moves plus or minus. A deviation like that is not an everyday type of situation, not an everyday type of occurrence. But when it does happen, it's not unknown either. It is certainly worthy of paying attention. And it was sparked by news that Trump posted this morning stating there were positive talks with Iranian counterparts over the weekend. The U.S. military has pulled back some of their offensive attacks. Specifically, they stated a halt on all energy and infrastructure attacks within Iran until Friday. I don't know if Iran responded with any type of a pullback as well, but that is certainly going on. The biggest mover in the markets right now, because of that, oil down almost 12% on the day. Energy stocks down a little bit. And that's because the Dow is up so much that the algorithms are just taking all stocks higher. But you see oil really getting clobbered in here, down quite a bit, 11.5%, almost 12% on the day, back of the news of Trump and positive talks with Iran. Gold continuing its meltdown. Wow, at the lows, 4,100. I wasn't awake at the time. That was taking place in the wee hours. But if I was, I would have looked at that 200-day moving average, a spike down there and said, "Oop, got to buy a little bit of gold right now." Didn't happen. Wasn't there for it. Oh well, move on. So as mentioned, S&P 500. Now, we have these upper lines. This one served as support, well, until it didn't anymore. Let's see if it acts as some kind of a resistance if and when prices get up to that point. So if you want to mark that down, those of you playing at home, 67.90, give or take, then we'll have the falling 50-day average. Again, not surprising that the S&P 500 reacted positively in here. News or no news, that was probably going to happen because it breaks below the 200. Again, hasn't really messed with it since last April, May, the tariff tantrum about a year ago. And then we've had this lower yellow line, the very important yellow line. So we were in the expectation in the Romulus Legion of some kind of a bounce in here. We didn't freak out because of this line with the rest of the retail and, quite frankly, professional trading crowd when they continue to sell their stocks. And now they're wishing that they had watched our videos because they sold at the lows, which is kind of how they do things, I suppose. We did not. Now we're looking, do we need to sell as markets have rebounded quite a bit from the Friday morning lows? And that gives us an opportunity to breathe, to look clearly and objectively, and to continue to pile up our gains for 2026. We are having a massively profitable year already. Massively profitable. Massively profitable. I mean, we are just killing it. So, again, markets moving up on the news. Resistance ahead, quite a bit higher, but resistance ahead. I'd like to see if we get a continuation within the S&P 500 with volume confirming. We want to see some accumulation days. In other words, we want to see big money saying that the lows on Friday, that they're done with that. The supply is out, demand is returning, and we want to see a breaking of downtrend lines, former resistance areas, moving averages, volume coming in. In other words, there's a lot of work to be done. A lot of work to be done before old General Romulus says, yep, let me get in and go for a big ride on the upside like a chariot with a rocket pack. What do you think about that? Go ahead, type in your comments, your thoughts, your questions. You want to throw a javelin, a palladium-tipped javelin my way? Go right ahead. Otherwise, let's keep working. So another reason that the Centurion Legion was not in a hurry to sell on Friday with everybody else, if you look at this circle around the financial sector, which until Friday, the worst performing of the 11 sectors within the S&P 500 sector, splice and kind of distributed out cut of the market. This is forming a bullish divergence. It is showing relative strength. Again, the weakest sector, however, you see here, bullish divergence down here, and it goes up on Thursday when the market went down, and then the market went down again on Friday, and the worst performing sector went up again on Friday a little bit. So you have to be thinking when you see behavior like that, Remember, a couple of weeks ago, we were the only ones out there in the entire world that told you about this. When software was getting slammed due to fears that the AI fear trade was going to eat this entire sector, was going to bankrupt Microsoft and 20 other large software companies, the cybersecurity grouping, they were all ready to just give it all to a bot, I suppose. Then the war breaks out, but that's a different story. However, we didn't know the war was coming when we were highlighting this very strong bullish divergence. Again, I challenge anyone watching these videos to find anyone, let me repeat that, anyone else on planet Earth, no matter how popular or famous their hedge funds or banks or broker dealers or portfolio manager or analysts are, that was was calling out this trade right here in software. Nobody. But you see that bullish divergence, not as prominent rather in financials, not as prominent in the financials. However, again, financials were such a weak sector over the course of 2026, really dating into 25 as well, that it was very noteworthy that we saw this bullish divergence and that we saw something start to push up in the ending, at least on a temporary basis, of this very strong correction that has been taking place in the broad market. Another negative byproduct of the war, certainly interest rates. Shortly, right after, it had been a downtrend here. We hit a multi-month low in the 10-year. Really, I don't even know how far back that low goes. Could be years. That was a not quite. So dating back here to last April. Got close though, didn't it? It got close to breaking the lows of the tariff tantrum lows of April of 2025. And that is certainly positive for the stock market. Interest rates go lower. Businesses and individuals are encouraged to borrow more money and stir up more business activity, which of course the stock market picks up on ahead of time and begins to price things higher in anticipation of that increased business activity. And then boom, war breaks out and interest rates go straight up and they hit a multi-month high just this morning. And then look at Friday's action as well. Again, a bearish byproduct of what has been going on. We see a pullback here. Oil prices at well over 100 a couple of weeks ago, 120 a barrel. Bearish byproduct of what was going on between Israel, United States, Iran, and the conflict in the Middle East right now. We obviously know that we're going to see inflationary bouts here coming when the April reports are put out, when the May reports are put out. Regardless of how low oil goes in the very near term, it was up long enough and it was up high enough that we will see some seep through, some dominoes fall in the inflation aspect over the next month or two. Will it continue beyond that? Will it just give a little bit of a temporary spike to the inflationary picture? That does depend on the price of oil. At 86 or 87 a barrel, that is not nearly low enough to put inflation back on that sustained downtrend that it had been on for the past 12 or 18 months. Okay, it has to see continued lower prices or moves in the price of oil, followed with lower interest rates from the 10 years and the other interest rate environment cohorts. And so, primarily speaking, we know what we have to do. We know when we have to do it, and we know why we have to do it. Okay, if you have any thoughts, comments, questions, put them in the section over there. Be glad to help you out if at all possible. Again, in the meantime, General Romulus, always looking for consistent returns, regardless of market direction. Reach me directly, RomulusTeaches@yahoo.com. Again, RomulusTeaches@yahoo.com. Okay, this old general is going to be very happy to get back to ancient Rome, but also looking forward to joining you again in a couple of trading days. That's all for now. Peace and goodwill toward men.